Hi, everyone. This is Mohammed Akram, and we are here to do the webinar on how to value illiquid level 3 investments. I have a esteemed panel with me, and we will make an intro. But in the meantime, we just want to do some housekeeping items. One of that is that everyone who will answer the questions, they will get the CPE certificate, and for this they need to listen 50 minutes of the webinar and also answer 3 out of 4 polling questions. And we appreciate everyone who is attending this. So before we waste any further time, I would ask my panel to introduce themselves. So let me make my intro first. If some of the people who didn't know me, I'm the founder of Akram Assurance Advisory and Tax Firm. We do audit and tax work for the private equity, venture capital, alternative investment funds, and we do provide audit and tax services to investment entities. My next is Lynn. Lynn, please introduce yourself.
Sure. Hi, everyone. My name is Lynn Carrero. I'm a managing director with Kroll in the Compliance Consulting Services, and we provide SEC consulting and assistance with SEC compliance programs to registered advisors, ERAs, and other regulated entities in the investment management space.
Simon, please.
Hey everyone, good to be here with you all. My name is Simon Koo. I am a director at Marshall & Stevens. We are a full-service valuation consulting firm with expertise in portfolio valuations for private equity VC funds, as well as other practice areas, transaction-related work, financial reporting, and tax reporting. And we have offices throughout the country.
Awesome. Thank you. Let's start the ball rolling. So today we will discuss the regulatory expectations, the risk, controls, enforcement actions by the regulators on level 3 investments. And then we also discuss what the best practices are for the valuation. So I think let's, before we go further for the polling questions, I would ask Lynn to give a brief overview on the agenda, that what listeners would be listening from you with your background.
Sure, absolutely. So what I am addressing are going to be regulatory expectations. So broadly, if you are an SEC registered advisor, an ERA, perhaps you might even be exempt, but you're dealing in the institutional marketplace. You know, regardless of your registration status, you have certain fiduciary obligations, but then attendant with your regulatory status are additional risks, controls that the SEC staff expects to see during an examination, and obviously the point of which is to avoid enforcement. So we're just going to kind of take a quick walk through around the regulatory framework within which you need to contemplate your evaluation approaches, and then I'm going to turn it over to the experts in the practical application, and Simon's going to talk about the actual valuation process and lead you through that.
Awesome. Thank you, Lynn. Simon, can you please brief?
Yep, sure. So yeah, we'll talk about, we'll start with kind of laying the context of the fair value standard and the hierarchy, and kind of what the purpose of doing fair value work is for ultimately. And then we'll kind of go into the valuation considerations of the different methods. And then lastly, we'll talk about sort of cases, maybe use cases and certain challenges in valuation engagements and in different sort of market environments.
Awesome. Thanks, Simon. So my job is here to help our listeners from audit point of view, that what are the best practices we look into when we audit the level 3 investments. So let's start with the first polling questions and see what we can do here. Okay, let me launch. Somehow one of the polling, I know some of the people may not be able to respond to that poll over there, but let me see how we can resolve this thing. How would you best describe your role? I think it's just a first polling question. If you can't answer this, seems like you are not able to launch that. So please, we can you can answer, and we will not take a different approach here for that. Okay, let's continue our conversation. Lynn, what do you think that fiduciary obligations and the regulatory risk are for the funds with the level 3 investments?
Sure. So, looking at the fiduciary obligations, the SEC has said many times that that the things that are attendant to your fiduciary obligation are those. One of the key factors is going to be the valuation, and that's because it's so much of what you do and the benefits and the services that you provide to your clients really end up relying on the valuation process. So the valuation typically in a lot of managers drives the NAV calculation of the account, which is the percentage, the figure that is typically a percentage of which is charged in management fees. Valuation also can impact incentive fees. There's also, in general, the impetus, if you will, to want to do good, to show good to investors. And so the valuation process comes through there, and people may make decisions to invest. So you can have circumstances in which some of your fund investors or some of your clients pay too much or too little for assets that are in their account. And then people who may be redeeming or leaving a vehicle will end up with too less. So there's a number of areas of conflict that the SEC is going to focus on. And of course, as a fiduciary, you have an obligation to act in the best interests of your clients. So that is going to be one of the main focuses of the regulatory environment, and we'll see that as we go forward.
Awesome. So question we have here, that do they have a valuation committee, or and if they do they need to keep minutes, agendas, all of things for that?
Sure. So one of the regulatory best practices, and again, it's going to depend on your individual firm, but one of the best practices is going to involve having a number of inputs into your investment and valuation, your investment valuation process. So, if you're a small firm, where there's really only, one or two chief decision makers, and you're interacting on a daily basis, then maybe it isn't necessary to have a formal chartered valuation committee. But if you have multiple portfolios, multiple investments, small teams of investment professionals, you may want to have a more formalized setting. And again, as we go through, that's going to line up with what the regulatory expectations are. In terms of minutes, I think that's a firm decision. Some firms want to keep the minutes so that they can refer back to them at a future point in time. Other firms view them as a potential additional documentation that could get them in difficulty with the regulator, or perhaps result in questions surrounding certain decisions from a litigation aspect. So that's really something that you should discuss with counsel. But at a minimum, we recommend that you at least do maintain an agenda and notes of any action items that might come out of evaluation committee meeting if you do have it. So frequently you will be asked to demonstrate that the valuations were approved, for example. And so if you have an agenda with the action items and then a summary of what happened in the meeting, that should be enough. But like we always say, the regulator needs to be shown that you're doing something before they give you the credit for doing it.
Got it. Thank you. Okay, so let's time for another polling question. So let me launch this time here. Hopefully. The polling question is, what is your main concern with regards to your valuation practices? A, selecting the correct pricing methodology. B, comparison to industry peers. C, lack of supporting documentation. D, market opacity. E, lack of independent review. F, vendor capabilities. So I can share the results so far. So A is the 45, almost 60% people opt for option A. That is their biggest concern, our main concern is so far. And I would say 10% said lack of independent review, and almost 13% said comparison to industry peers, and 16% said industry. Okay, awesome. Let's move to the next. These compliance controls and valuation committee, which we discussed a bit, but yes, I think we can hear these things here too. So my question to Lynn is that do they need a third-party valuation firms, and what are the pros and cons from regulatory firms? Can they do in-house valuation, or do you recommend them that they need to have a third-party valuation firms to manage?
Sure. Yeah, we get this question a lot, and really, I don't believe that the SEC takes a preference. I know, if you look at the most recent private funds rule, there was kind of the concept of putting in place a fairness opinion when there were conflict of interest transactions, such as, selling on in a continuation vehicle or advisor sponsored secondaries. So I think, the SEC, that's not to say that the SEC is not concerned that you're getting your valuations correct. But I think it comes down again to what is reasonable for your firm and what controls you have in place. And if that is sufficient and you feel as if you're getting to a good position and also fulfilling your obligations or requests from third parties, your investors or other constituents. So I would say if you're going to do an internal valuation process, most firms do, even if that internal valuation process is just a shadow process. One of the key factors is going to be looking at your policies and your procedures and making sure that they outline, who is responsible for the valuation process, who has the ultimate authority to approve it, and then what, information or frequency with which those reviews will be conducted. And Muhammad, as you mentioned, we talked about the valuation committees or other governance considerations. I think we talked fairly extensively about the valuation committee, but some of the things that they can be used for other than just charters and minutes, but you can have them approve specific policies and procedures. You can have a valuation committee actually be responsible for maintaining the oversight and removing the conflict of interest from the portfolio managers. So they would identify circumstances in which you want to bring in that third party. Maybe it's a case of we need additional information. Maybe it's just a case more so that we would like the assurance of an independent opinion.
Right.
So really it's going to be focused more on what your firm is doing, the underlying investment, the expertise you have in-house. But from a regulatory perspective, the focus is going to be on that part of it, which is the process. How did you arrive at that? Who was involved? Was it reasonable? And at the end of the day, did you secure a reasonable result?
Simon, any intake from you? Because what do you see that more appropriate in different circumstances?
Yeah, I would say from a not necessarily a regulatory point of view, but what we are seeing is when we talk to LPs, is that this is a question they have a lot, is we don't have any visibility as to their mark, particularly if they're doing, their valuations in-house. That seems to be a common concern amongst LPs and pretty sophisticated ones as well, right? Is that the information that they're getting and receiving, the updates, it's not as transparent as they would like. So you can kind of see a little bit of uneasiness when they talk about that topic.
Thank you.
Yeah,
So,
absolutely agree with that, Simon. I think, the real move toward an independent valuation resource has been more so from the commercial aspect than the regulatory aspect.
and then the next question is, do they need annually, quarterly? What's the frequency of valuation would you recommend? And again, it depends on smaller funds or may not be able to afford quarterly valuation or annual. What is the best practice in that frequency of valuation?
Yeah, so I think, broadly from a regulatory perspective, the rule around it is, Rule 20647, which requires that you adopt policies and procedures that are reasonable. So I think, every firm is going to be a little bit different. If you are in the smaller cap space with venture capital, where you've got maybe multiple rounds of financing occurring while you're holding an investment, you'll need to do a valuation more frequently than annually as those things come up. If you're, holding something that's a little bit more stable, it's more of an operating play, if you will, that maybe an annual valuation is really all that you need if there aren't, changes that would impact the valuation during that period. So I think most firms will at least take a quarterly review whether or not they engage in an actual full valuation process. So what we mean by that is they will sit down and say, have there been any events? Are there any economic conditions that might, change how we feel about the investment since the last time we valued it? And if so, then maybe we undertake a full valuation. If not, then maybe we table that until the following quarter with the idea that at least everything gets valued on an annual basis. Simon, I don't know if your experience is different.
I think that's pretty consistent with my experience as well. I mean, there's different companies like BDCs have their own regulations and framework to follow. They're more, they got to do things on a quarterly basis for the most part. But exactly to your point, Lynn, it really kind of depends on the facts and circumstances around the investment, the materiality of it, like kind of what happened between quarters. So there's usually sort of a light touch at least between quarters just to kind of monitor these investments, right? But then to Lynn's point, maybe the more fully kind of scoped valuation is kind of reserved for the annual updates, barring any sort of significant movements.
Thank you. I have one quick question here, and we get this question a lot. When we're doing our audit work and they have a level 3 investments, the VC funds, and they will ask, can we provide you the calc instead of valuation? Calc means not with the opinion, just the calc. What is your point of view, Lynn, from regulatory perspective, and Simon from overall, because calc will cost less and valuation is you're taking more responsibility by the valuation firm. In what types and circumstances would you recommend calc over valuation? Obviously, valuation is better than calc, but any insights? Start with Lynn and then Simon can chime in.
Yeah, I don't know necessarily. I think again, it would revert back to what the reasonability is, what the circumstances are, why you're doing one versus the other. But I think everyone or broadly would like to see the full valuation where it's possible.
Yeah. And you don't provide services other than the full valuation report or opinion? Don't do the calc, right? Is this the firm policy overall for you guys?
I'm sorry. In terms of, go ahead, Simon.
I was going to ask Mohammed, are you asking Lynn or?
Simon probably relates to you that if the client is asking and he doesn't want to pay for full valuation, would you be okay giving the calc instead of valuation because it's less risk for you, but also for me, it's not as acceptable for us being an auditor. So what would you do in those circumstances?
Yeah, we do provide types of services like a positive assurance, which is less weighty than a full scope valuation. So it just carries, we're not really opining on the value, we're just kind of testing predefined things like the calculation. It could be a calculation. So it's just the ownership is more in the hands of management in those cases, but these kinds of things like a positive assurance helps support that, but it doesn't carry the full weight of a full scope valuation, an independent valuation. And we make sure that our letters kind of state that, disclaim that as well.
Okay, that's okay. So these are the best practices. Lynn, if you have not discussed any one of those, please feel free to highlight it.
Yeah, I mean, I think, just broadly, these probably aren't going to surprise anyone, but these are sort of the types of things that will create a circumstance where the SEC may cite you during a regulatory examination. So You always want to make sure that you have written policies and procedures to comply with the necessary compliance obligations. One question we get asked a lot is how detailed those need to be. The actual compliance policies and procedures don't need to be extraordinarily detailed at all. They just need to essentially include what your process is, who the individuals are that are responsible for undertaking it, and the documentation that needs to be retained. So you don't have to get into real granular level in your compliance manual. Looking at establishing an internal pricing committee, a valuation committee, having them reviewed by an independent advisory board, and then just ensuring that you're continuously monitoring. So as Simon and I discussed earlier, even if you are not going to undertake a valuation exercise, you still want to at least demonstrate that you're not just ignoring whatever might be happening during the period between the official valuation dates. And then again, a third item on a best practice is appointing an independent valuation provider. And it doesn't need to be every time. It doesn't need to be for every investment and every valuation policy, but to Simon's point, it's good to have someone else take a look to make sure that you're using the most up-to-date methodologies, that you're using the most current information, that back to our poll question, that you're in line with industry peers who might have similar investments. And that might be information, if you're in the private investment sphere, that isn't necessarily that easy to get. So having that independent person who might have a better, viewpoint into others' approach would be really beneficial.
So there are fund admins who are involved in sometimes in doing the valuation. I have, being an auditor, I have seen that they're doing a valuation. They're also doing the books for them, striking a NAV. What do you see from regulatory point of view? Can they provide both services at the same time? They're doing the valuation for them, also providing them the thing. There's no conflict of interest or any of those things from SEC point of view.
Yeah, I think if you're going to work with your administrator on pricing the portfolio, it's going to be, we're going to get into level 3 valuations, but, looking at the portfolios, if the valuations are being obtained by the administrator through a pricing service, you'll want to just understand which pricing service they're using, follow up with them just like you would with any, service provider oversight. If you're looking at level 2 investments, where they're having to come up with a valuation by, sourcing the market, collecting information, you're going to want to look at what resources they're using. Are they collecting broker quotes? How many are they collecting? What's the method of calculation? And make sure that, at the end of the day, if they have the final approval, that you at least have a very good understanding of how they reached that approval level. So it's not a case of you can just turn it over to them and then the administrator becomes responsible for ensuring that you have the right process. So they can undertake it on your behalf, but you still have that obligation to make sure that they're taking a reasonable approach. Again, hearkening back to the fiduciary duty.
But Lynn, my question was, thank you for giving us a detailed response, but my question was more with those VC funds where fund admin is doing their books, tracking, determining the net assets value, but also providing them the valuation services along with that for all the levels in investments. So do you see
the SEC, like I said, is going to look to see what kind of oversight is being done by the investment manager to the fund admin do they have a review and a sign off? Or have you, like I said, walked away and just allowed the admin to kind of do a straight through processing? So, I mean, there are definitely potential conflicts of interest there that need to be resolved. But as long as the investment manager doesn't completely delegate their obligations, then it's not an automatic regulatory issue.
Okay. I think let's jump to the next one, next polling questions, and then we can, which of the following are part of your current valuation process? A, written valuation policies and procedures, internal technology systems for retaining and monitoring the fund's holding data, maintaining a pricing valuation committee. D, compliance has transparency into the process. E, engage independent viewers and vendors. We'll just give them a minute or so they can respond. Okay, I believe majority of the people said A and E. So we are going to close this poll and move to the next one. Lynn, this is the regulatory expectation. Do you want to mention this in enforcement action here? Give us a little bit background on that.
Yeah, absolutely. So, this was a fairly recent SEC enforcement action around valuation processes. So effectively, the investment advisor agreed to pay $79.8 million to settle the charges brought by the SEC for overvaluing CMOs that were held across approximately 20 advisory accounts, but 11 of them were also retail mutual funds. So if you want more information on this action, you can click on the link provided in the presentation. But effectively, the SEC ruled that their processes and their documentation were insufficient. Over time, the reason that the penalty was so high is that you have 11 retail mutual funds which have daily trading. So there's a number of investors impacted with incorrect liquidation and subscription pricing, incorrect fees for a period of time. So, there are a number of regulatory issues that can flow out of getting the valuation process incorrect. And I think it's important to note before I turn it over to Simon that the SEC will rarely, if ever, I hesitate to say never because you never say never, but rarely, if ever, will they argue with you about an actual valuation and say that they disagree with you that the value should be higher or lower. That's not their role. That's not what they're there for. Where they will, though, is argue with you that you didn't pay enough attention, take enough time, bring in enough points of data, and really, take the intent to, from a fiduciary standpoint, get the most accurate answer. So from a regulatory standpoint, it's always the process, not necessarily the outcome that is going to be your weak point. So I think that's why the process steps that we're going to talk about with Simon coming now are going to be an extraordinarily important part of staying on the right side of the regulators.
Awesome. Thank you. Okay, so Simon, or probably you will take control from here, and please, there are a lot of accountants, CPAs, fund managers are on the call, and they were really looking forward to um, help us how to do value these level 3 stages. So please start.
Got it, sure. So as I said before, we'll just kind of set the context of, you know, the purpose of these valuations. Really, it's to kind of communicate the value, fair value is the standard that we're following to investors and to the users of the financial statements that have their investment reported on, right? And so the FASB accounting standard classification is 820. We call that ASC 820 for short. It is also, for the most part, in harmony with IFRS 13. They're pretty much identical. There's some nuances, but it is in harmony with the IFRS standard as well. And there's some key points here that kind of stand out from this slide. I think a lot of you, since you are CPAs and accountants, auditors, are familiar with, you know, with this topic here. But I'll just kind of state the definition of fair value. It's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And there's some things that are listed here, some bullet points that are important, but I'll just kind of summarize the key points here, okay? So one of the things is the exit price versus the entry price concept. And this is pretty important too, because sometimes, and usually the case, the exit price will be aligned with the entry price if it's sort of, you know, a trade or a recording of a transaction at that point, right? But there could be cases where you might have gotten a good deal, right? And you're paying below fair value. And so what this accounting standard classification is saying, well, what would happen if you flip that, right? It's really important to consider the exit price from a market participant standpoint. Really, that's the key here in fair value measurement, is considering what is the value of this from a market-based market participant standpoint. You know, it doesn't really consider your view specifically. It can, as you are probably part of the market participant pool, but it's not sort of solely on an entity specific measurement. It's kind of like, this is one of those cases where it's like, you know, your mom says, don't think about what other people say, just think about what you think about yourself. Well, it's kind of flipped in this case. It's like the FASB wants you to care about what others think about your investment, how they're going to view the price of it, the valuation of it, more than you are, right? And so that's the kind of key takeaway, is that everything is based on a market participant standpoint, okay? And then we'll go into the hierarchies. I think we can go into that here. So we'll kind of go into each of the level classifications, the hierarchy that is under ASC 820, the fair value standard here. But the key takeaway here is that the reason for this, that, you know, that the FASB set this up 15 years ago or so, I think originally under FAS 157, if I'm getting that correctly, is that it wants to communicate the riskiness of the measurements of the different investments, right? Not necessarily the riskiness of the assets or the liabilities that you're holding, but the riskiness of how things are measured. So that's the reasoning for the level, the fair valuation hierarchy that you're seeing here between level 1 and level 3. And I think most of you are familiar with kind of the differences in these different levels, which I can go into in more detail in the following slide here. Okay, so level 1, sometimes referred to as mark to market, I think that's what it is. I think it is the next slide. If you can go to the next slide. Yeah, so these essentially the key things to understand here is that these are direct observable quotes from an active market, and that's really the key there. So these are, for the most part, unadjusted direct quotes that you're getting from a major or active market, right? And the important thing is here is that these quoted prices are not adjusted, right? They're just kind of taken directly from a reliable source, right? Some examples of this is, you know, like a very liquid, you know, a share price from the NASDAQ or the NYSE, right? That's an example of a level 1 input, also a level 1 price that you can use to price your level 1 asset at, right? It could be also exchange traded futures and options, on the run treasury bills and notes are another example. Mutual funds that are struck daily, the NAV, that is, like these are traded in such a manner that they're considered active, and so the price is usually a reliable indicator under a level 1 quotation. Okay. So the other thing to sort of leave on this slide is that the level 1 criteria is very narrow, right? So it has to be unadjusted direct quotations, active markets. So anything that doesn't meet that is probably going to fall into the next category at least. So it's going to be at least a level 2 asset if you deviate away from those 2 critical points. Okay, so we'll go on to level 2 now. So level 2 assets are anything else from, you know, what we talked about in the level 1 inputs, right? So these can be quoted prices for similar assets that are in active markets, right? Or they could be quoted prices, but in inactive markets. So you can kind of see like one of those things are left out in the level 1 criteria, right? But you have at least one of those, the same overlapping criteria there. And so examples of a level 2 asset, you know, it could be some things like, you know, you have direct input on an interest rate swap, right? You have a market-based curve, right, on interest rates, and you are going to use that to price that interest rate swap using a non-proprietary model. It could be something like the swap function in Bloomberg is one thing, right? The key there, it has to be a non-proprietary and standard model, right? It can't be something that you built that's based on your sort of take on what you think that asset could be modeled and valued at. And it has to be, again, like a market participant based model that's widely used, right, and unaltered. Let me see if I can give you some other examples on level 2 assets. So the other thing is broker and dealer quotes are used too. And it could be that you are getting a broker quote, but the key thing to understand here is it needs to be something that they're ready to execute on, and it can't be stale, right? So those are the key things when you're relying on broker and dealer quotes from inactive markets if you're trying to price a level 2 asset. If you're using a broker quote, let's say you have 1 or 2 quotes that seem to be reliable, those brokers need to be able to execute it at that price at that measurement date. That's the key thing to understand, right? And the mark to matrix thing is something that we see with pricing services, such as like a, you know, IHS or Market. Bloomberg has their own thing too. Reuters, Thomson has a similar function, but this is kind of, they put together a model or sort of a map of similar assets in active markets, or, you know, assets that are in active markets, but that have sort of current broker quotes that are reliable, right? And so it's going to map out and, based on similar measurements like your sort of maturity date on your debt instrument, for example, credit rating, things like that, you can kind of, it can be interpolated the price based on these level 2 types of inputs, right? And so that's an example of the mark to matrix type of method that we see in, especially in fixed income pricing. Okay. And then for level 3 is really kind of everything else, right? This is sort of your unobservable inputs, your sort of full modeling of, private investments that don't have, either a level 1 or level 2 type of criteria in terms of the inputs that you're using. And just to kind of give you an idea of the gray area between a level 2 and a level 3, it's going back to my sort of interest rate swap example. Let's say it's 5 years, the term is 5 years, and you have, let's say the term is 10 years, and you have only curves up to, year 4 or 5, right? And you have to interpolate the second half of that. Well, the standards kind of tell you that if it causes a material impact, or if it could be a material impact from that point on, that interpolation of the remaining 4 or 5 years for the forward curve, that's probably going to fall under a level 3, because that's high. That kind of falls into the subjectivity of the person that is modeling it out, trying to value it. So that gives you an idea of sort of the transition between a level 2 and a level 3 asset. So the level 3 assets is kind of where my firm and sort of my expertise falls into, is kind of full modeling of equity and debt investments, still using observable inputs as much as possible, but where the modeling is clearly kind of falls outside of the level 2 sort of category and criteria and requirements. Okay.
And Simon, I thought there was one interesting point on that slide, which is that publicly listed, excuse me, in certain situations, publicly listed securities can be level 3 securities, in the same manner in which publicly listed securities could be level 1 or level 2, depending on volume, depending on capitalization. So it's really important that you look at all of the factors and you don't just assume it's a level 1 security because it's listed on an exchange, because that might be, a price that was obtained 4 years ago.
That's right. That's a very good point, Lynn. Like we've encountered cases where it's publicly listed, right? But the trading volume is so low, the bid-ask spread is just is pretty wide compared to sort of more active market standards, that the auditors weren't comfortable using that price to mark that investment, and so they had to come to us to value that, even though there was some price quotations, right? So that gives you an example that just because it's publicly listed, it's traded in the public markets, doesn't necessarily mean that automatically that's going to fall into the level 1, level 1 category.
So if they come to you guys, then you guys will treat as a level 3 or level 2, some kind of blockage discount, some kind of discount, and to determine.
Usually we just go straight to level 3. In my experience, I don't know what other firms have, but usually when it happens, we'll do sort of a full scope analysis where we do, the standard valuation methods.
So
yeah, I think it depends if it's, if it's a circumstance where maybe you participated in a PIPE, so you've got some shares that are restricted for a certain time period. So they're not at the present day worth the actual market price. Those might land you not in a level 3. You might just apply, a haircut. So it's more of a level 2. But you know, it really depends. It's not, to Simon's point, from a regulatory perspective, they will definitely ask you, like, when was the pricing date? Like, how did you get it?
So while we are discussing this thing, what is your opinion on these digital assets coins, right? Would you consider them level 1, level 2? Are any preference by regulators? Lynn or Simon, what do you think these digital asset coins, or it should be done?
I can't say that I have experience in pricing digital assets at this point. It's something that's, you know, on the radar, but I can't really comment on that with given my experience with that category.
Yeah, I think from our experience, it's again very similar. I think if you're looking at the more popular digital coins, where there's, you know, observable inputs, you can make a trade at the market right then. You know, those are closer to a level 1. But if you're talking about NFTs or art, for example, those are, you know, likely going to be much more in line with a level 3 asset. So I think, again, it depends what type of digital asset you're talking about, and how popular or prevalent it is, whether it actually has an active market to be able to justify its valuation, that kind of thing.
But Lynn, they're priced differently at different exchanges. Coinbase might have a different price versus Kraken or other. There will be some difference in between, not like standard price. And for that reason, I think we have noticed some firms are doing it level 2. But what is your take on that? The firms who are doing it level 2 instead of level 1, and we have seen obviously all those billion-dollar valuations coins, right? They should be valued at level 1, but certain coins might not be, might fall into level 2. What do you think overall from that?
Yeah, exactly. I think the factors that you just talked about, they're going to expect that you will look at that and design your valuation process and procedure to take into account those different factors. So, you know, if you're looking at, you know, theoretically, when you're going out to trade, or not theoretically, it is the case, when you're going out to trade a public equity, you might get a variety of different prices that are off by pennies or mills of the pennies across a variety of brokers during the transaction. And so, you know, you end up understanding kind of what the end of the day price was, or what the mid was. And so it is an observable input. But to your point, if you're talking about exchanges that have material differences in their carrying value, then I think you have to resort to a level 2, similar to what you would with like OTC instruments.
Right, right. So let's, Simon, anything would you like to add here for level 3 before we jump to the polling question, the last polling question you have?
No, I think we can jump.
Okay. Is what percent of your assets under management fall into level 3 category? A, 0 to 10%, B, 11 to 25%, C, 26 to 50%, D, 51 to 75%, then E, 76%. We have few minutes left. After this polling questions, we will ask some of people submit their questions online, so we will try to answer before we leave. So I'm going to wait for another 20 seconds, and then we will start asking those questions. Oh, sorry, there is other material to go. I think we should close this poll and jump on that one before we answer. Yes, please.
Got it. Okay. Going into the common and primary valuation methodologies to value predominantly level 3 investments. Again, some of these are probably familiar with you all, your viewers here, is that the market approach, which is looking at comparable public company market multiples, such as an enterprise value to revenue or enterprise value to EBITDA. It could be a price to book if you are trying to value, let's say, a bank or an insurance company. Falling under the market approach is also comparable transactions. So these are actual transactions that could be comparable to the company or the interests that you're trying to value. A previous transaction in the subject company stock or the last investment round. This is also something that we use to as a data point for valuation. What comes out of that? It could be like implied multiples, certainly the price. The key thing here to understand is that it needs to be assessed to make sure that it's a material transaction and it's arm's length. Those are the kind of key things to keep in mind if you are relying on that as well. And then the firm offer. This is something I would say that needs to be balanced with, it can't, usually in my experience, it's not something that you can hang your hat on entirely. It needs to be sort of balanced with these other types of valuation methodologies. Let's say you have a firm offer, a transaction that hasn't closed yet, for example, right? There's an implied multiple. You still need to kind of kick the tires with these other valuation methods as best practice. So the other common method is an income approach. This is usually like a discounted cash flow, a DCF for short, and it's really just projecting revenue, earnings, and ultimately cash flows, discounting them to a present value using a risk-adjusted discount rate, for example. And then the third approach is sort of what we call a cost or an asset-based approach. And this is common in real estate, for example, as we value the asset based on its replacement cost, for example. Machinery and equipment is sometimes in the scope for evaluation, so that also entails using a cost approach in that respect. Okay, moving on to the next slide here. And I think, Lynn, you can chime in here. This might be more in your court here, but the methodologies should be considered on a variety of factors, including sources of prices, priority, how the sources are used, and methodologies generally include readily available quotations, broker-dealer quotes, third-party pricing services, proprietary pricing models, and original cost of investment. And I think in my view, the key takeaway is that the sources and priority of these sources is really observable inputs. You want to prioritize the things that are observable as much as possible. And then if you're using a pricing service, it's not enough just to say we're going to take it as it is. You really have to kind of go into the pricing service to make sure how they're coming up with the prices and what is it based on, and if they fit the fair value criteria, right? For example, if you're using it to mark a level 2 investment.
Okay.
Kind of continuing on with methodologies. So the common securities or investment types, when we value common equity, it's usually through an enterprise value method, which uses a mix of typically an income-based method or a market approach, right? The most common method is to value the enterprise value first, and then sort of you take out the debt and sort of non-operating assets liabilities to get to your equity, right? Preferred equity, convertible for preferred, it starts with a similar approach as the common equity. I would say here that, usually when we value the preferred, we'll kind of run it through a waterfall from the enterprise value, along with the common equity as well, if there is more of a complicated capital structure. Complicated meaning more than one class of share and more than one sort of priority and sort of the income stream, right? So anything that's not a simple capital structure kind of falls into that. So oftentimes we'll use an option pricing method because we want to think about the forward aspects of some of these different instruments, particularly like options, warrants, right? Where if you do a current value method, really that's the sort of simple waterfall where you kind of, do the simple sort of subtraction of your enterprise value, your debt to preferred, and then your common. Sometimes if you do that, you're not going to get any value in your options, right? But from the FASB's perspective, is you have to consider the time period of the enterprise in terms of the ultimate liquidation, and that has implications on the option value, as you know, right? There's going to be time value of the options that need to be valued, and that's really what the FASB wants you to reflect, is sort of that aspect, the forward-looking aspect of it there. And then fixed income debt type of securities here, your sort of plain vanilla debt is valued using a DCF-based method. It's usually the spread-based method is usually the go-to method for a performing debt instrument. If it's non-performing, we kind of fall back into a recovery method, which it starts with an enterprise value approach and then kind of seeks to see how much that enterprise value could cover, its debt stack, right? If it's a convertible debt, our method is usually to strip out the option component of that debt and separately value those two kind of instruments. We'll value the option portion of it, and then what's left is sort of the plain vanilla part of it, and then we'll value that separately. Other considerations here is discount for lack of control, and then discount for lack of marketability. One of the key things here is, I think in prior history there was some things called blockage, discounts for blockage, or sort of volume discounts, right? That is not allowed under the FASB, and I think they came out with something 2 years ago where they said even underwriter lockups, you can't discount the value of your the quotation of of this what could be a level 1 or level 2 asset and apply some sort of marketability or illiquidity discount. And the reason is because that that lack of illiquidity is not characteristic of the asset itself, right? And so it's more of a characteristic of the holder, not the asset. And so these blockage discounts are no longer applied. For the most part, there are some exceptions. It's called the portfolio exception. For the most parts, these blockage discounts aren't applied. And I would say, just to kind of sum up that point, is that the practice has been moving away from applying discounts for lack of controls for minority positions versus majority positions. And the reason is because the view is more of you're like in a consortium of investors who in the aggregate have control of the assets. So if you co-invest, for example, on day one of the transaction, you're going to be paying the same price as sort of the sponsor or the controlling shareholder, right? So it doesn't really make sense to sort of say, oh, well, your value should be, 20, 30% less because you're not the controlling owner. Because ultimately you're going to exit with the same pro rata share of the proceeds when that investment does ultimately liquidate. So that's the view currently on that. Marketability discounts are applied, but sort of, it's usually applied to more junior classes of securities. We don't typically see DLOMs for like preferred securities. It's usually kind of reserved for, common securities, warrants, and options. Okay. I just wanted to pause here. Timing, I know that we're, a little bit over our allotted hour. I just want to see if we're on course to continue, or do we want to streamline this a little bit?
I think I would say that we can just mention this best practices, and I think pretty much these are the 2-3 slides are left. If we can go quickly, and then we can answer a couple of questions people have asked.
Okay, so I'll kind of go through this quickly. So again, I think what we've been talking about, we brought this up a number of times, but the best way to conduct your valuation process and procedures is really to get familiar with the fair value framework and to make sure that you are pricing or valuing your assets according to the criteria that's laid out in that framework. Okay, and there is some guidance on valuation. The most recent, it's not authoritative, but it's very influential, and it's kind of what I've been using and what the valuation community at large has been referencing is this AICPA PEVC accounting and valuation guide. I think that's the short name of it, but that is sort of a go-to guide in the practice. It's really useful to get familiar with, and that was, I think, finalized sometime in 2019. So again, what we've been kind of we've been saying before is just kind of maximizing observable inputs as much as possible, maximizing the use of calibration. And so what calibration here is a technique really kind of to sort of base your value as closely as possible to the parameters of a material or the original transaction. So what this means is, let's say you have a change of control transaction. You go out year one and you want to value it. The guidance is saying that, well, don't start over. You don't have to reinvent the wheel. What you want to do is kind of go back to the original investment, right? If it was deemed a fair value transaction, right? You want to reference that, and you want to see what the parameters of that transaction entailed. So there's usually an implied revenue multiple or an implied EBITDA multiple that came out of that. There could be an implied required rate of return or a discount rate. Those things could be rolled forward and updated based on current market conditions. And really, you want to explain your valuation based on that original reference point, right? And this calibration technique can be updated every time there's a material transaction, right? So the guidance, the PEVC guidance that I just explained, there's a lot of emphasis on the calibration technique there. Okay? Another best practice is to use more than one valuation method, right? Sometimes we see, the PE firms, they'll sort of just use a market approach, for example, or a DCF, right? And best practice is to kind of triangulate values as much as possible using multiple sources. It's not necessarily a requirement that you have to use more than one, but it is a consideration. just some of these are pretty straightforward, common sense, but to be internally consistent in how you're applying inputs and your application of your methods. Having reliable support and documentation, I think this is really key. Is what we sometimes see lacking in PE firms is we don't get the rationale for the valuation, right? And I think having that documentation, especially when you don't have full data points, you have limited data that you work with. You could be sort of a co-investor where you don't get the full information that a sponsor might have, right? And so you have a limited sort of set of data to rely on. I think that becomes even more important, is to say, well, we reached out to the sponsor, we were able to get data, but this is kind of what we know. I think that's really important, is to kind of have a regular cadence of making sure you have support and documentation in each measurement period. And then lastly, is just sort of using third-party valuation specialists to kind of validate your valuations when needed. So this is especially important when the auditors determined that there's some assets that are investments that are more material than others, or they're more risky than others as well. Okay, so the valuation challenges that we sometimes encounter, and that are sort of that are kind of current actually in the last 5 years, right, is that we've seen during periods of kind of volatility between measurement periods, sometimes it's sort of like people scratch their heads in terms of how do you value your investment when prices are going down, up and down pretty quickly. There's kind of like sharp changes in the market over a kind of a short-term horizon, right? And sometimes we get that question as to how we can sort of accurately value our investment considering these market movements, right? And so technically, the way that we kind of view the market participant view is that the markets are, for the most part, efficient, right? Especially if it's sort of like an S&P 500 type of thing, where you have a very liquid pool of diversified assets, right? Things like that. It's hard to argue against that, right? And so at the very least, you need to kind of consider the broader market movements, such as the S&P moving down, let's say, significantly during COVID, after March of 2020, right? So you need to consider it, right? But usually what we see in practice in the private markets is that there's somewhat of a wait and see like approach that we see that the private markets tend to adopt, right? And usually it's because they're valuing their investments, not only on like the public markets, but they're also using transactions, right? And so usually it's a weighted approach. So the price changes or adjustments in the private markets kind of lag behind the public markets. And so it's sort of something that you want to consider with your auditors. Sometimes the short-term movements might not be definitive of pricing your asset in terms of the measurement date you're doing it at, right? That the sharp downturns might not be indicative of the sort of the real price of the asset, if you were to consider other data points such as transactions, right? Transactions, they're not going to necessarily transact in the private markets during periods of high volatility. They're going to kind of wait it out and see how things kind of shake out before they really kind of get into sort of doing deals. And so that could be a consideration too, that you kind of raise with your auditors, to say, well, the public markets aren't really definitive of my price at this measurement date. I want to consider the other principal market, which could be the private transaction market, right? And so there's some ways to kind of smooth that effect out in that respect. And then again, the key thing there is to really kind of document the rationale behind that, right? Of your sort of your thesis in valuing or pricing that asset. Usually though, like in real estate, with what's going on with the commercial, like office space, for example, you know, there's not a lot of price clarity, not a lot of price discovery. Eventually though, like they need to kind of conform to what the markets are saying, like for example, the REIT market in like office space. There needs to be some sort of conformity, at least beyond sort of the short term when you're pricing these. So eventually, I think that there's going to be some correlation between private market prices and public prices in the longer term. Right? And so some of the things that are used as sort of an averaging of multiples, like in periods of kind of short-term volatility. You know, rethinking recent transactions in which to calibrate. Let's say you had, you know, transaction that occurred before COVID, right? But that's not necessarily going to be a transaction you want to rely upon or calibrate on, right? You need to make adjustments to that if you're going to be doing that based on potential impacts to the industry of the portco that you're valuing, right? That needs to be assessed, right? In terms of like a discounted cash flow approach during periods of volatility, right? Something that you need to consider is like your base case projections and doing more than sort of one scenario. You know, usually we'll just work with an expected case scenario, but when things are volatile, when things are a little bit more uncertain, it's best to do sort of like a scenario analysis where you do like a downside case or an upside case and kind of weight those considering the current market information and the impacts, for example, to the industry of the portco. Okay. The discount rate too is something that could be affected during periods of volatility. The beta, what we saw in betas, for example, in calculating discount rates, we saw some sharp changes for different industries. And so there is, you need to kind of consider, you know, basing it off of a longer term beta assumption or kind of rethinking whether the beta that is shown is really indicative of the long-term prospects or the long-term dynamics of that industry that the portco is in. Okay. Some of the other things to think about is inflation and rising costs. So what we saw here in our experience was that, you know, when we did some of these updated valuations, what we saw is they didn't really kind of foresee the persistence of inflation and then supply chain problems, right? There was always sort of a more, you know, we're about to turn the corner. I think it's going to normalize now. And so what we saw is there's a lot more persistence of these costs and inflation than it was expected, which sort of impacted, you know, their margins. And it turned out that, you know, their forecasts were a little bit more aggressive than an actual what actually panned out. Kind of going on to that point is continuing on with that is like forecasts sometimes, you know, could be optimistic or aggressive, right? In terms of if you're sort of benchmarking that with analyst forecasts or other industry growth forecasts. You know, we often see forecasts that are sort of hockey stick in nature. And really the kind of thing there to understand is to, again, have that documentation and rationale of that forecast, right? Like why is it going to exceed, you know, your comparable company growth forecast, for example, right? do you have synergies in there that should not be included, right, from a market participant standpoint? So from a market participant standpoint, it's really about market participant expected synergies. So there's things that you want to look at to make sure that you're aligned with the market participant standpoint, in not only your costs but also sort of your growth, your growth drivers as well, your growth rates. That is okay.
Simon, anything else? Or we should, I think, already late a lot. So is there anything you want to add here at the last minute? Then I want to take one.
No, I think I'll kind of just, I think, we can kind of hit on
Question.
the key
I think
points.
that is more from the attendees, and we'll try to answer those questions later on too. But yes, Simon, anything you want to say at the finishings?
Yeah, I'll just say that, the use of third-party vendors, I think it's pretty common sense. They need to be independent, to have some experience and expertise in the asset class, understand the stakeholders, like the auditors and regulators, like have experience in working with auditors, for example, or the IRS if they're a stakeholder as well. Ability to kind of support the valuation well documented, to be able to kind of have a clear rationale, to again speak with the stakeholders of the valuation, and having the resources and the capacity to sort of meet the volume of these investments.
Thank you. So, question to ask. I think one of the participants asked that regarding that case, Lynn, you have mentioned where SEC penalized $80 million. The question is, did they penalize the auditors too because they didn't do the job right, or anyone else other than the company? If they can check the more details, but they are asking if you have some insights.
I don't recall off the top of my head whether there were additional actions associated with that or not. I'd be happy to follow up on that afterwards. I can send you an email that you can send out, but otherwise, if you click, the link will take you to the press release, and that should have the additional info.
Okay. The last question for Simon, right? So anything, the last crux of your presentation, what would you tell auditors that what they should be focused on in their
What I would tell auditors?
Yes.
Yeah, I think for auditors is, I think they're sort of a key player in our value, the audience of our valuation, and to continue to make sure that, you're looking at the requirements of the valuation provider, the things like having proper documentation, rationale, expertise. I think those are going to be continuing to be important factors for auditors and their reviewers.
Awesome. I want to thank you, Lane. Thank you, Simon, for going more than an hour here, and I apologize for my listeners that sorry we took a little bit longer, but I thought it was very helpful conversation. You must enjoy that. So there's another question, if you guys, I think Simon, you should ask, how frequently should advisors? We have already discussed that, but there are some other questions too. Let me see. You can take any of those. But Simon, can you please respond?
What is the question?
So, sorry, I can ask you another one. For listed companies with a low volume trade activity, can we use the last transaction value as a market value if it is not old more than 12 months? Please guide.
Yeah, I don't, Lynn, do you have better insight onto this one here?
Yeah, I think Yeah, it's really, it's a facts and circumstances, which I know really isn't helpful. But I think if the security has a history of being in and around the same amount, i.e. it's not moving that much, then it might be more reasonable to say that a 1-year price isn't stale. But if it's something where there may not be a lot of volume in the market, but there's a lot of activity in that particular sector or with companies or things like that, then a 1-year last transaction price may not be reflective of the actual value.
Yeah, typically in my experience,
So,
like the 12 months
Austin,
is considered pretty stale. 6 months is usually sort of a kind of a cutoff in terms of considering recent transactions.
there was a question, I think we answered that, but I can repeat again. How frequently should advisors value level 3 investments? I would say at least annually, but what is the best practice? Quarterly? Please, Simon and Lynn, answer them, please.
Yeah, I mean, I think a lot of my clients undertake a valuation process quarterly, but it's not a full valuation process as we talked about. I think it's more identifying whether there's been any additional material inputs, either things that have occurred in the economy at large, or whether that particular portfolio company or a piece of real estate had significant events or something to that effect. If not, then I think, to your point, Mohammed, at least annually, you should undertake a full sort of soup to nuts valuation or revaluation at a minimum. Obviously, there's a number of events that could trigger more frequent review.
Okay, so another question they ask is why digital assets are still level 2 investments, and also they have active market.
I think it depends on which digital assets and which markets. So, as we talked about, some of the exchanges have much more, much higher volume. There's much more outstanding coins than there's other ones that, where the digital assets are really more one of a kind assets, which always gets more of a level 3. Because you're looking, potentially at the intrinsic value versus the, market value, that kind of thing. So I think if you're talking about, Bitcoin, Ethereum, those are probably closer to the level 1. But, outside of sort of those larger widespread digital assets, I think you're looking at least level 2, if not level 3.
Simon, next question to you, if you can please help them out. During audit, how to verify the reasonableness of investment managers' estimates when dealing with highly uncertain future cash flows or unpredictable economic environment? And in the absence of market comparables, how do we auditor establish whether the inputs provided by the investment managers are free from bias or manipulation?
I guess what I would say there is there needs to be some benchmark to something, right? Whether it's some sort of industry measurement or economic measurement. Usually, it's hard to see how there isn't some sort of comparable analysis that's done. Sometimes your company could be in a niche area where there might not be any, let's say, direct comps, but there could be some adjacent comparable companies that that could be looked at as sort of a secondary set of data points, right? And so I think the first step is to make sure that you're doing all you can, right? Whoever is valuing that investment is doing all they can to kind of see, to make sure that there's, you know, data points out there that that could be considered, right? And then the other thing is, again, just getting that view from company management in terms of how they're developing their inputs, their forecast. There needs to be a clear rationale as to how they're arriving, for example, at their forecasts, you know.
Got it. Thank you. Again, want to thank you, Simon and Lynn, for the time and effort, and thank you for all the listeners who participate. We will definitely send you the CPs certificates based on our phone calls. Thank you, everyone.
Thank you.
Thank you.
Thank you.